Good morning, ladies and gentlemen, and welcome to the show on this Thursday, December the 15th. And thank you for tuning in. I'm glad to have you guys here. Now, it is what it is with the Fed. You know, they're trapped. But it's taken a long time for it to really play out what's happening. Let's get in there and let's take a look at the markets. And let's open up the charts right here. The Fed raised the rate by a half a percentage point again. Now, these rates that they've been raising are cumulative, and they're talking about more increases likely. It's had a very negative effect upon the markets this time. Well, you said, well, when they were raising rates 75 basis points, which is even higher than the 50 percentage points they're raising them now, why didn't the markets react like they're reacting now? And the answer is because the rates had to get up to, because they're cumulative, they had to get up to a certain point where they would start, where everything would start to respond to what the Fed's doing. Now myself, I thought it would respond quite a bit earlier. I didn't think the rates would get up this high before we would see this response by the markets. But I was saying all along that the Fed's not going to stop until the markets react. And the markets are not going to stop being hopeful until the Fed stops. So it's like one thing is playing upon the other thing, and now what it's doing is finding its equilibrium. That's what's happening. In other words, we're hitting the point now where every time the Fed raises rates now, the markets are not going to take it kindly. What does it say here about this? Continue reading. That's what I need to do. Fed raises rates by 0.5 percentage points, signal more increases likely. It says most officials pencil the plan to raise rates above 5% next year, higher than previously anticipated. Washington, the Federal Reserve approved an interest rate increase of 0.5%. Signal plans to lift rates through the spring, and they're not going to get there. I didn't think they were going to get this far, and really I don't think they're going to get a whole lot further now at this point, because the markets are really starting to respond to this. Finally. Take a look at the silver price today. It's down 78 cents at 23.15. And let's take a look at gold. Gold is down $29.90 at $17.77. You might be asking yourself, why should the markets respond so heavily to these interest rates? Interest rates are a very sensitive thing. And why they're so sensitive is to the price it costs to borrow money, looking out into the future with compounding interest. It's a very sensitive to even a quarter 25 basis points even can affect whether a borrower can afford to make that loan or not. As interest rates goes up, the price of money becomes cost more and more, and the more money you loan, and it takes more money, what we call money, which is actually debt, to run the system all the time because of inflation. So people have to make bigger loans from the banks in order to accomplish the same things they used to accomplish. And the more money you take out, the higher the interest rate. It just doesn't pay. And so after a little while, when interest rates gets too high, it stops borrowing. And that's how money is really, I shouldn't say created, that's how debt is created within the system. If you stop creating debt, then solvency just dries up, disappears. It's kind of the same effect as, to understand this, for you guys to really understand this well, is think of a farmer that does irrigation. Say he farms by irrigation. Say he's farming on the edge of the desert, and he's got a crop he's growing out there. And as long as the taps are open and he's extending the water out to these crops, the crops are flourishing, they're growing, and the fruit's coming in off of these crops, and everything's fine. But say he shuts the taps off. Well, for a few days it's going to be okay until the crops start to dry out because they're not getting enough liquidity or water. And then the whole thing's going to go to hell, go to pot. Well, that's what the Fed's done. By raising interest rates, they're shutting off the taps. And it's going along for a little while. Now it's starting to react. The vegetables are starting to dry out. The liquidity's starting to dry up within the system. They've pushed this just about as far as they can push it. But now, if they change direction, inflation's going to roar back. So this is why they're trapped. And if inflation roars back, did you know something like food insecurity in the United States is just because of inflation, and they've only got the inflation down just like 1 percentage point is all. If they turn around on all these policies, inflation's going to go right back up, higher than it ever was before. And also there's the effect of the people saying to themselves, hey, they can never stop doing this. They can never stop borrowing more and more and more, yet more money into existence. And prices continue higher and higher and higher, and the people just actually start to give up in the end. And they start to capitulate to this, and they start to say, hey, you know what? We're just going to go along with it. We're just going to spend this money as soon as we get it. We're not going to save any longer. What's the point in saving? Savers are suckers in a system like this. But right now, there's hope. People are storing dollars away because they're hoping deflation's coming. But when that hope is lost, then you're only going to be a sucker for hanging on to dollars. And that time is coming, because I know which way this has to go in the end. And I've been saying this for years. I know it has to go inflationary, ultimately, in the end. Because of the cost associated with deflation. The crashing system that would cause. They can't pay that cost. Nobody, no politician, no banker, nobody can pay that cost of what deflation would cause if they went in that direction too far. So you see, we've turned the corner on inflation. Inflation's going down quick. Right now we are in what's called disinflation, and we're headed toward deflation. They cannot let it get as far as deflation. They will not let it get as far as deflation. They will react. But they still got a little bit of room to play with. Anyway, so you kind of know where we're at in all this. Taking a look at cryptos today. Crypto is taking a little bit of a beating. It's at 17,449 for Bitcoin, and Ethereum is at 1271. Let's take a look at the Dow Jones. And we've seen a big drop today, 765 points down at 33,201 on the day. Crude oil is off 74 cents at 76.54. And now we're going to check the MOVE index. Is at 120.26. The MOVE index has really gone nowhere since way back in April. In April is 131. In fact, it was around 120 in May of this year, and it's went nowhere. It's just been going sideways, basically. We had an upward trend that continued. I mean, the upward trend in the MOVE index started in December of 2021. It went right on through until about May of 2022, and it was a solid upward trend. And I thought it was continuing when we saw these two peaks here at 156 in June, or I should say in July. But no, it's sideways. Bonds and rates today, we're seeing falling yields on the long end, rising yields in the middle. This is increasing the yield curve inversion. Look, the U.S. 6 months at 4.7, and we're looking at a 30-year at 3.4. That is a big yield curve inversion. Okay, so we're looking at a 10-year at 3.45. It's down 4.6 basis points, and a 30-year at 3.48, and it's down 5.4 basis points. And now checking our dollar index for the day is at 104.46 on the dollar index, and it's rising a little bit. Thank you guys for listening to my show. Like and subscribe. And we'll catch you guys in the next episode. You guys have a great afternoon. Bye bye.